Welcome to Section 33, where we're going to continue our discussion on transaction value, but specific to the possible inclusion of foreign inland freight in calculating transaction value. This is an important section, so let's get right down to work. One area of potential confusion related to transaction value is that of origin inland freight. The question being, should it be included in transaction value? And what we're talking about here is inland freight from a foreign vendor to a port of export. Second bullet, in general terms, the price actually paid or payable is considered to be exclusive of costs incurred for transportation, insurance, and related services incident to the international shipment of the goods. This is the essence of the whole discussion. International transportation is excluded from the calculation of transaction value. The question is origin inland freight considered part of international transportation? Sometimes it is, most of the times it isn't. So foreign inland freight will be included under most circumstances. Let's see why in just a moment. With the above stated, there are some nuances associated with the subject of foreign inland freight. Just remember the term, is foreign inland freight incident to the international shipment of the goods? Is it included in the international shipment of the goods in the form of a through bill of lading? In general terms, if the price actually paid or payable by the buyer, that's the U.S. importer, does not include a charge for foreign inland freight, those charges will not be added to the price. On the other hand, and as a general rule, in a situation where the price includes a charge for foreign inland freight, whether or not it's itemized on the commercial documents, that charge will remain part of the transaction value to the extent it is included in the price. First bullet, and this is where things really get interesting. If it can be proved that foreign inland freight is incident to the international shipment, then it can be deducted for purposes of determining the transaction value. Here's the real key point. Second bullet, the above scenario implies a through bill of lading under a door-to-port or door-to-door move. The inland freight is included in the ocean bill of lading. The ocean bill of lading represents the international transport. Therefore, it can all be taken out of transaction value. That's the whole story here. As a trade tip, in order for foreign inland freight to qualify as incident to the international shipment, the through bill of lading must be presented to the district director at the port of arrival. Let's throw out a real-world example to help illustrate this point: transaction value and foreign inland freight. You are a trade consultant with a firm in Chicago, and you have been asked to offer an opinion on a client's question regarding transaction value and foreign inland freight. Basically, the client buys furniture in Malaysia and ships via ocean freight to the U.S. As a part of that program, they contract directly with two ocean carriers on a port-to-door basis. The bill of lading charges include charges from the port, the international transportation, and then domestic on-forwarding in the United States to the door. Last sentence in the first paragraph. The importer believes that they can deduct foreign inland freight from their transaction value. Is that true? Second paragraph. Pursuant to the details found in 19 CFR 152.103A5, that's pretty specific, foreign inland freight can only be deducted if it is incident to the international shipment. This means that the inland freight would have to be part of a through bill of lading from the door of the vendor's factory to a port or inland point in the U.S. Last paragraph. Because the importer buys on a port-to-door basis, the inland freight would be separate from and not incident to the international shipment. As such, in this case, inland freight cannot be deducted from the transaction value of imported merchandise. Good, solid example, the essence of what we're talking about. We mentioned 19 CFR 152.103A5. Hopefully you knew that we would show it. This, of course, being an excerpt from ECFR 152.103, transaction value, we're looking at A5, foreign inland freight and other inland charges incident to the international shipment of merchandise. And one can see that we're using the exact terminology in the slides that we've put together on this subject. If the price actually paid or payable by the buyer to the seller for the imported merchandise does not include a charge for foreign inland freight and other charges for services incident to the international shipment of merchandise, those charges will not be added to the price. 5.2. Sales other than ex-factory. As a general rule, in those situations where the price actually paid or payable for imported merchandise includes a charge for foreign inland freight, whether or not itemized separately on the invoices or other commercial docs, that charge will be part of the transaction value to the extent included in the price. However, charges for foreign inland freight and other services incident to the shipment of the merchandise to the U.S. may be considered incident to the international shipment of that merchandise within the meaning of 152.102F if they are identified separately and they occur after the merchandise has been sold for export to the U.S. What they're saying there is a through bill of lading. If the inland freight at origin is part of a through bill of lading, door to port, door to door, it can be deducted. That kind of money, that kind of expense for inland freight adds up and can be substantial over a period of time. Let's do a classification using transaction value. We've actually been doing that anyway with the previous examples that we had. Let's focus on it specifically. In this slide, we're going to set the stage for our little exercise. The following exercise centers on the use of an overseas vendor's commercial invoice to complete the process of classification and valuation using the transaction value method. This exercise involves an assist in the form of a mold provided by the U.S. importer to the overseas manufacturer. This should be very familiar. We've gone over this a bunch of times. Our focus is on the product description, unit or quantity, the country of origin, and the price actually paid or payable for the imported merchandise. Here's our scenario. A U.S. importer of footwear and athletic equipment. The product description is men's basketball shoes, outer soles and uppers of plastic and rubber. Unit price, $20 per pair. Country of origin, Peru. And the assist is a $1 million mode with a capacity for 500,000 pairs, which would imply that over the life of the mold, on a per pair basis, the value is $2 per pair. $2 per pair times 500,000 pairs equals $1 million. That's where that's coming from. Here's our invoice. What do we have here? The seller, full name and address, out of Peru, sold to a company called Aventura Sports Gear in Savannah, Georgia. In the upper right-hand corner, what we're going to focus on here, because it involves transaction value as well, are the delivery terms, which is FCA Callao Port, which implies that the vendor pays inland freight from the factory in Lima to the port in Callao, separate and not incident to the international transportation. Should that amount, that inland freight, that drayage from Lima to the port, be baked into the price to the U.S. importer, it remains there because that inland freight is not incident to the international transportation. It's not going to be a through bill of lading. It couldn't be with the FCA port Incoterm. That's important to point out. Let's go down to the middle of our invoice. What do we have here? 2,000 pairs of men's basketball shoes, outer soles and uppers of plastic and rubber. That's a concise description. It's going to match what's found in the HTS-US. The gross weight, we put in pounds, no problem there. Cartons, dimensions in pounds, no problem. $20 unit price. $20 times 2,000 pairs comes out to $40,000. Here's the assist, and it has to be included in the transaction value. $2 per pair value of mold assist. Marks, we put in there. Arrival port, that is required on a commercial invoice, as we saw in our study of customs regs for commercial invoices. Country of origin, Peru, but the value of that assist is $4,000. The total FCA Callao price is $44,000. That is the transaction value of the merchandise. A good illustration of how transaction value should be calculated. We looked at inland freight. In this case, it didn't qualify to be taken out of transaction value. and we looked at an assist. Good solid stuff. Since we're here and doing a classification and valuation exercise, both classification and valuation, we go to HTS Search, which we found to be a very helpful tool. Got to a heading of 6402. Got to a subheading of 640205. We see at the top, tennis shoes, basketball shoes. There's our description. Move down. For men, that's good for us. Work footwear, no. Other, no. For women, no. Down we go past other. And then value over $12 a pair. In our case, these men's basketball shoes were $20 a pair. So we are at a legal classification of 6402.9190 at a general rate of duty of 20%, but these goods are coming out of Peru. And guess what? Peru has a free trade agreement with the United States. PE is the designation. Free of duty. A solid exercise to go through because it allows us to talk about transaction value, reach the proper valuation, and classify while we're here. That's actually 4 classifications that we've done in this module. And then in the next slide, we went straight to the HTS US page, and it's the same visual, just presented in a PDF format. We will zoom in and circle it down the bottom of the page. 6402.9190 is our legal classification, valued over $12 a pair, free of duty. Let's summarize our final results. We got our HTS number at the 8-digit legal classification of 6402.9190. If we had continued down the page, we would have got to our 10-digit legal classification with an extension of 05. Our entered value was $44,000, $40,000 for the basketball shoes, and $4,000 on the assist. Customs duty free, based on the Peru-U.S. Free Trade Agreement, as designated by the uppercase letters P.E. And as a note, if this product had been imported from a column 1, subcolumn general country, say for example Italy, the duty rate would have been $8,800 based on that 20% duty rate that we saw in the column 1 general subcolumn. It should be pretty clear, or we can at least hope, that this company, this importer, knew that Peru had a free trade agreement and that this product qualified for it. That's a strategic sourcing decision. Sub-bullet to wrap this up, merchandise processing fee and harbor maintenance fee will be discussed in detail in an upcoming section because we didn't include it here. Okay, that's that for section 33. When we come back, it's a look at deductive and computed value.